start playing out tomorrow. Rajeev Malik of Macquarie joins in to tell us how global investors and stock markets may be positioned for this big event outcome. Rajeev, morning. Thanks for joining in. Which way is the wind blowing for you?
Well, the macro news flow is clearly improving, and that's cutting across all of Asia. The striking thing with India, obviously, is the political uncertainty. It's anybody's guess what the outcome of the elections is going to be. But I think it's reasonable to assume that a third front dominated or led government, which was always an outlier risk, remains an outlier risk. I think most of the indications seem to be that particular outcome is a bit on the defensive. A reasonable assumption post-elections is that government formation would be tricky, take a few days, a week, 10 days or so, in which case you will certainly see volatility as far as markets are concerned, unless, of course, we are surprised positively and either the BJP or the Congress lands up doing much better than expected.
Rajeev, morning. While we tend to obsess a little bit about these 10-day, 15-day volatile periods, are people worried about the longer-term ramifications as well of this election outcome?
I think the key really is whether it's excessively populist in government or not, and people generally would equate a third front or the left-related things with that. Although it's interesting to see, Congress, which obviously always claims it to be the original reformers, landed up being pretty populist as well. I think the fact of the matter is in India, political parties and politicians say whatever needs to be said to get elected, but once they're in the driving seat, reality dawns, and things really are never as bad as, what is perhaps indicated in the run-up to the elections. If you were to, start believing any of the quote-unquote manifestos that have been announced, you clearly would go into convulsions. But there's a very good chance that almost all of them, rather most of them, majority of them, would not necessarily see the light of day. So yes, there is some genuine concern in terms of excessive populism coming into works, especially given the current state of the fiscal. But again, I go back to the standard example of 1990s. There were 4 different governments. It didn't necessarily change the broader India story.
The last government did not have too much by way of policy elbow room, Rajeev. Are global investors hoping that the UPA plus the left or supported by the left does not come back because that would lead to policy paralysis like the last time? In that sense, would the NDA be a preferred outcome for global investors or even the markets?
To be fair, I think at the margin, and one could debate about the broader economic backdrop that faced each government, I think NDA's track record in terms of broader handling of the economy, especially in terms of reforms, I'd say was perhaps better than that of the UPA. Don't forget, NDA, despite, the BJP leading it, which has a more nationalistic overtone, did at least make a move on some of the more unpopular measures. Whether it was FDI, whether it was disinvestment, whether it was actually going ahead and touching the sacrosanct small savings rate. Whereas I think the Congress for the longest time has made the left as a convenient, beating boy for all that it could not do. But I think there are elements within the Congress that would be not so much as anti-reform, but clearly with strong socialist overtones, which I think held back the broader process as well. So I think on the margin, India perhaps has more to speak for during its tenure than the Congress.
Just want to get your thoughts on where the currency fits in with this, Rajeev, because the feeling is that if there is a negative outcome, the one that is more vulnerable to a D-rating is probably our currency.
All of Asian currencies are structurally undervalued but cyclically challenged. And as the broader economic improvement, and I don't even use the word recovery for now, begins to seep through, all of them will continue to rally. And I think rupee is no exception. Could have a bit of a hiccup following a negative election result. But the broader improvement globally in terms of capital flows in India's own current account setting will still suggest that rupee will continue to strengthen. I still stick by range of 46, 48 by March 2010, and that hasn't changed for some time now. All of Asian FX is going to rally, and we've already seen part of that picture unfold, and more of that is going to come through in the second half of the year.
How will the financial markets, forex and equities, react post-Monday, Rajeev, in your eyes? If it gets the sense that either the BJP or the Congress has got close to 150 and therefore some coalition will be cobbled up, do you think it will be happy and react positively for all markets? Or will the composition of any kind of coalition be looked at very closely by the markets in the answer to whether it will be a stable coalition and last the course of the next 3 to 5 years?
I think it's very much going to be the latter. I mean, at the end of the day, it's really a question about how stable the ultimate coalition ends up being. And in India's case, what typically happens is also the least important part of the coalition can still be instrumental in deciding whether the coalition stands up or collapses. So I think the initial take will always be on numbers, but the quickness with which a coalition is formed and how markets perceive it is stable will be the more decisive factors.
Does the longevity of a combination really stand as more important in the market size, Rajeev? Because some have pointed out that there have been combinations at the center in the past that have done a lot in a shorter period. In 2 years, they got a lot more done by way of policy action than this 5-year stretch we've had with the Congress.
Well, I think that's true in certain cases. If you go back and think about early 90s, Narasimha Rao government came in with very, very low expectations. People didn't even think that it would last very long. And lo and behold, it landed up doing a fair amount. And there were other similar examples. I think the challenge this time around really is over the years, the national parties have weakened further. And, regional or state-dominated parties are having more of a say, which once again, indicates that they are less focused in terms of any kind of a national agenda. Having said that, I do think, on issues such as fiscal, for example, there has been across the political spectrum acknowledgement about, both the severity and the need to do something about it. Don't forget, this is a country that actually did ultimately manage to pass the FRBM Act. This is the same country that at some point in the 90s, middle of 90s, managed to get rid of automatic monetization of the fiscal deficit. So, strange things have happened and they could happen again. But before you get to that, you just need to have a working government in place for some time.
A quick word on the basic economy, Rajeev. Do you see the signs of improvement as durable signs stretching into the next few months, or do you subscribe or lean more towards the W theory?
No, I think India is going to be more of a secular improvement on a gradual pace. I think what you'll find is on a good number of countries in Asia, certainly Singapore, Taiwan, Korea, which are dominated by electronics, the inventory build-up in the second and potentially third quarters will have a sizable impact on headline numbers. In India's case, where the main casualty was really on the investment side and the policy response has been double-barreled and pretty aggressive, you will begin to see more improvement and sustainable improvement at that coming through. My own sense is I think we are perhaps just a month or 2 months away from the GDP upgrade cycle in India kicking off. I do think people have become way too bearish overall.